Okay, good morning, everyone, and welcome to Macros with your host, Tony. We'll be going through Canadian CPI data, inflation data for Canada. Hopefully, you can all hear me and also see my screen clearly. Don't forget to share this video with your fellow friends or fellow traders if they want to get some sentiment or an understanding of what the Canadian CPI release is all about. So all you got to do is just share the link, and no one has to sign up. They just can click on the link and away they go. So Canadian CPI then. So we got a little bit to go through, not too much data to kind of run through or sentiment or other background information. But let's have a check as to what it is. So what is Canadian CPI? So it's the prices that consumers pay for goods and services. And why is it important? Well, the Bank of Canada, they follow the headline and core inflation readings. And when they've seen that inflation ticked well above expectations in the past, that they've taken very aggressive action, like the one that they did back on July 13th, where they did a 100 base point rate hike rather than an expected 75 base point hike. So that's, again, a key reason why the Canadian CPI data is very important to look at, and can see some volatile moves in the Canadian dollar. Then how does it affect the markets? So if we're looking at the basic version in a normal environment, so for currencies, a high inflation reading is generally bullish for the Canadian dollar. Of course, that means if CPI continues to tick higher or is seen as if there are stronger pressures within Canadian inflation, then that will lead to the central bank maybe taking stronger action, or if you're not in the rate hiking cycle, maybe the central bank could start raising interest rates or to tighten monetary policy. So for bonds, for bond prices and for bond yields, of course, is the key difference. So if bond prices, if there is a better than expected reading for the inflation print, then bond prices would usually see movement towards the downside. We've seen in the past, not only with Canada, but also in the US and Europe and the UK as well, when inflation data has been much higher than expected. Then, of course, on the flip side for yields, of course, if bond prices are lower, bond yields go higher, right? So there's a demand that needs to be met and controlled. So whenever the government sells bonds, what they do is that they will, of course, provide, if the economy is doing really, really well and there's no tightening environment, they will set bond prices quite low, and they will make sure that and then they will sell those bonds with a high yield at a cheaper price. But of course, in the tightening environment, similarly, except now it's the markets and the central bank taking that aggressive action to spur the government to set the rates quite low, or the bond prices quite low, and the bond yields quite high or higher as rates are increased and inflation continues to tick up. So that's so again, in a tightening environment, that's what you would expect. So for stocks, and if you haven't seen how the markets reacted to rate decisions or inflation prints, then just to go over it again, that would a higher than expected inflation read. It leads to a tighter monetary policy environment, which can cause a depreciation or bearish reaction from the markets. So if you do get a high inflation reading, again, as said, that could lead to the central bank taking stronger action from with raising interest rates or tightening monetary policy, and in turn that leads to lower valuations for the stock market. Now, of course, we've also got to understand too that if traders are expecting inflation or the interest rate to come in at a certain figure, then you would have seen the markets pricing that in with the stock market and also the currency as well, and other areas of the market too. So that's one thing to be aware of. So only when there is a big shock to the figures, or the figures are unexpectedly high or low, that's when you expect more volatility from markets. Other than that, you don't really get a lot of reaction sometimes. But in recent times, we have seen where if inflation data comes in as expected, traders think that inflation may have peaked. So then what you would see is the opposite. You see the currency see a move towards the downside, and stocks see a move towards the upside, in hopes or in thinking that the central bank might not take strong or aggressive action in the future. So that's how the markets are affected by the CPI release. Hope you all understood that. And then if we're looking at the previous report, so CPI in Canada hit a near 40-year high in the highest since, or nearly the highest since the highest since 1983. So so remember, if you had joined me beforehand, you would know that with the CPI data, it was around, it had hit a 30-year high. Okay. And of course, with last month's data as well, that kind of cemented that inflation is still ticking up quite strongly in Canada. Hence, the central bank took that 100 basis point rate hike beforehand in July 13th. So this is so if we're looking at other bits of the report too. So on a year-on-year basis, consumers were paying 54.6% more for gasoline in June, following a 48% increase in May, contributing to the most to headline consumer inflation. So that's quite interesting. Now in the US, you had seen that, for a couple of months, the gasoline prices have been going down and have weighed on the CPI print, where you've seen slightly, the data that we had last time, where we had seen lower than expected inflation print altogether or overall for the US. And that had contributed to positive reaction to the stock indexes, negative reaction from the currency. But there's a slightly different story in Canada. We're still seeing high gasoline prices that Canadians are paying for. So that's could be a worrying factor for the Bank of Canada going forward when they set their rate decision. But if we do get weaker pressure or less pressure in gasoline prices, then that could mean that the Central Bank of Canada might decide to go with a smaller rate hike rather than a big, huge rate hike at the next meeting. So another major source of inflation this year was, of course, food prices, which rose by 8.8% in the past year. That was the same price increase seen previous month but economist Tu Nguyen with audit, tax, and consulting agency RSM Canada said that it's too soon to conclude that food prices may have peaked. So again, you're getting from a leading consultancy firm, a tax and consulting firm, by the way, in Canada, and one of their economists saying that it's too soon to say that food prices have peaked, which could lead to a stronger inflation print in Canada, such as in the US, where food prices have been the strongest part of the report. In Canada, in the US, it could also similarly be, you could see gasoline prices and food prices continuing to go higher. Numan Zafar says, hi, I'm from Pakistan. Hello, good to see you. Glad you've joined. Hope you're finding this useful so far. Don't forget to share it with your fellow traders and friends who may find this information useful. So that's what, according to an economist from RSM Canada, is saying. So that's just something to be aware of, that we could see a continued elevated inflation pressures. We may not see a downward movement as some may be expecting. But again, that's of course up to how the data comes out. So the triggers then for the economic release. So the month-on-month high. So this is data looking at what economists see the high and low estimate for CPI month-on-month. So they're expecting a high estimate of 0.3% for the month-on-month data. Now the month-on-month median forecast is 0.1%. So they're expecting a 0.2 deviation. And then with the low of minus 0.4%, so about 0.5 deviation on the low end. For the Canadian CPI year on year, they're looking at a high estimate of 7.8%. So again, a 0.2 deviation on the high end. And then on the low end, the lowest estimate, they're looking at a 0.6% deviation on the low end. So that's something to, so again, I think when we go through the deviations, I think we'll be looking at a slightly higher or a bigger figure or bigger deviation from what we've seen in the past reactions. For both sides, but we'll go through the deviations in a little bit. And any questions that you have, I will answer those once I've kind of finished this up. It won't be too long. So the Bank of Canada, their views on July 13th on the rate decision. Of course, some of this has slightly changed, but more or less the same. There's been nothing new really that's been said by the Bank of Canada or other members other than Macklem. Understanding the inflation, they underestimated inflation since the spring of last year, owing primarily to global factors, high commodity prices, increasing supply constraints, and rising shipping costs account for 2/3 of the missed inflation. Of course, they front loaded with their rate decision by, instead of doing 75, they did a 100 basis point hike, much bigger than expected. It was a surprise. Nobody was expecting them to do a 75 basis point hike, so it was a nice surprise, nice movement towards the upside for the Canadian dollar. And then they also, they expected inflation to average 7.2% this year, up from 5.3%. 4.6% in 2023, up from 2.8%, and 2.3% in 2024 versus 2.1%. Macklem on July 20th, what he said is that Canada's inflation is to remain painfully high this year, as in a CT interview, adding that inflation will probably remain above 7% for the rest of the year, and inflation is likely to be lower than June's 8.1%. So that's quite interesting. You don't really get central bank governors saying whether to expect, the inflation to be lower for the upcoming report. They either say that price pressures remain elevated, or they're quite strong, or they're weakening. But they don't really say, they're expecting it to be lower than 8.1% than the prior figure. So this is something that I guess has already been factored into economists' views. They're expecting the CPI year on year to tick down by 0.5% to 7.6% compared to the prior of 8.1%. So that's already been factored in. Now, if that goes much lower than 7.6%, you're not really going to see a good reaction from the Canadian dollar. Remember, you want, if you're looking for, from what we've seen in the past, if you're looking for a positive reaction from the Canadian dollar, you'd want inflation to be higher than the forecast, completely blow it out of the water and skyrocket. But if Macklem is saying that it's expected to be lower, nobody knows how lower he's expecting it to be, then that's something just to be aware of. That we might not see too much reaction if it's already been factored in by economists and the markets. Then, where is the economy at the moment? So inflation, of course, at 8.1% versus a prior of 7.7%. Month-to-month CPI a tick lower, 2.7%. versus 1.4%. GDP quarter-on-quarter annualized rate, of course, we're going to get that in about a month, with the next quarter. We're going to get that quite soon, actually. So that was at 3.1% versus 6.7%. Employment change came in better than expected compared to the prior at minus 30.6K versus minus 43.2K. Average hourly earnings also had seen a bit of a tick down to 5.4% versus a prior 5.9%. The unemployment rate unchanged at 4.9%. And then the raw material price index was in the negative at minus 0.1% versus 2.5%. PPI year on year, or producer price index, at 14.3% versus 15% to the prior. And of course, the current interest rate at 2.5%. in Canada versus 1.5%. So this is something to be aware of, that these a couple of figures here, the RMPI, or the raw material price index, and the PPI year on year, seeing a move towards the downside, and also average earnings year on year seeing a move towards the downside too. Now, if employment is weaker and the average earnings or hourly earnings is also weaker too, that means that you've got to take that as that there is less money that is potentially going around within the economy. Okay. If consumers are not getting that much of an income, or there aren't that many jobs being created at all, then, or you're seeing less jobs being added to the economy, that means there are less consumers that are able or possibly or potentially able to spend money on goods. You just had the Canadian housing starts data, by the way, on the financial news site up here. It was 275.329k, so higher than the forecast of 264.1k. But anyway, getting back to this here, so it could mean that this, as I said, if economists are factoring in that price pressures are weakening or dampening a little bit, that could already be factored into the forecast. Now, sentiment then. Has inflation peaked? So this is something that all traders have been focusing on for the US data and then in other areas too, in the Eurozone, the UK. This is the key thing. So this will mean where do central banks go, right? Do they go stronger and faster with the rate hikes, or do they, kind of keep to their, or do they slow down with their rate hikes if inflation is starting to ease up? So this is what's caused the markets to kind of whipsaw up and down. You had the non-farm payrolls figure not too long ago, where it was better than expected. Then the CPI report, which was lower than expected, which caused a whipsaw in the markets. So inflationary pressures are very, very key, and those economic indicators are the main focus for traders at the moment. Also, on top of that, you have earnings too, or how businesses expect, or the big dogs in the US, how those businesses that are expecting, what they're going to be doing with their hiring, whether they're going to be slowing down hiring, like a couple of the businesses wanted to do or have done, like Microsoft, Google as well. There's talks of that. Walmart have got their earnings coming up next week. I'll double check on that. But they're going to be quite interesting to see whether or not they give any further detail as to whether they're going to continue hiring or slow down hiring too. So not only do you have inflation, being a key thing, as from what we had seen last time or last week when inflation slowed, slowing inflation drove traders to reduce bets on Bank of Canada raising interest rates by 75 basis points next month, perhaps the highest level since 2008. Traders are expecting, that, okay, if US inflation is down, that means that other central banks could follow suit and maybe do smaller rate hikes. But we've seen from the Bank of Canada that they've kind of gone in their own direction to a degree, where they've done a surprise 100 basis point hike and have admitted that they were wrong with inflation or underestimated inflation altogether. So yeah, similar path to other central banks, but more or less kind of going in their own direction with, kind of going with bigger rate hikes compared to what markets are expecting them to do. And then if we're looking at investment bank views as well, so we had on the 10th of August, so we had some other points too to be made. So economists, they said that if inflation slows or appears to have peaked, Matt Clement and his officials may decide to may decide to go for a lower interest rate hike after stunning the markets in July. However, many economists believe that raising interest rates to more restricted levels is the better course of action. So what does that mean? So one inflation print showing that, if inflation does head lower, isn't going to be enough for the central bank to slow down with their rate hiking path, or their very strong rate hiking path. And that's kind of been evident with the US, right? We had 1 month of data about a couple of months ago now, where you had a negative, or you had a lower than expected inflation print. So markets were expecting the central bank or the Fed to hike by a smaller amount. But then the following month, inflation skyrocketed again. And then you had the central bank take stronger action instead. So this is the thing to be aware of, is that 1 month's data of inflation going down isn't enough, right? You need a sustained path of inflation continually heading down for at least 3 months or so, right? To kind of cement, okay, inflation has peaked. Then you start to maybe see central bank saying, okay, we probably don't need to do a 75 basis point hike or a surprise 100 basis point hike, or get to our target range where we want to get to sooner rather than later. So that's something just to be aware of, is that, you've got to, that's what economists are saying, that maybe continuing with the restrictive or stronger rate decisions is a better course of action, basically. And then if we're looking at the previous release, then, so we go about 10 minutes before the release. So about, let me just bring this up here. So we're looking at the previous release that we had for July 20th from the Canadian data. Now I've got, I'll go through the deviations too, but the key thing from the last report is that there wasn't too much of a deviation from the releases. There was about 0.2 deviation in the month-to-month, and there was a 0.3 deviation on the year-on-year. So this was the market reaction, right? Just looking at the figures before we look at how the markets reacted, or before I play the video. So there wasn't too much of a reaction to it. It was okay. Yes, there was a movement there, but it wasn't so strong compared to what we've seen compared to other releases. Where we've seen, like this release here on April 20th, where we'd seen a 0.5 deviation on the upside and 0.6 deviation on, for the year on year, where you'd seen about 21 pip move on the dollar CAD, and about 22 pip move on the euro CAD, GBP CAD, about 23 pips. The key thing is that when you kind of see that inflation is becoming, let's say, if the central bank has already factored in, or is already taking inflation as a serious, or taking it even more seriously and more of a focus, should I say, they always take it seriously, has more of a focus on CPI inflation data. Once you've seen like a bunch of rate hikes, go on and on and on, then we can see that actually the inflation report is seeing a bit of a dwindle in its importance to a degree. I won't say altogether, because it is still quite important for the central bank to see inflation peaking or slowing down. But from the market reactions, even with a 0.2 deviation or a 0.3 deviation, you haven't seen too strong of a reaction recently. So this is why I kind of said, maybe looking for a 0.2 deviation in the month-to-month isn't going to be enough if you're going to get a similar reaction here. You'll probably be looking for at least around a 0.4 deviation to get a stronger reaction, at the very least, from the month-to-month and the year-on-year. Both of those figures there, see a stronger reaction. So you'd want, if you're looking to, if you're expecting, if you're looking for the Canadian dollar to strengthen, then you'd want the data to be much higher than expected and have a big deviation. Whereas if you're looking for the Canadian dollar to go down, you'd want inflation to either come in line with expectations, okay, or be much lower than the forecast. Okay, and as I said, I'd look for a 0.4 deviation either side, on the high end or the low end, for both the month-on-month and the year-on-year figure. So hopefully that should kind of answer your question, Numan, that you asked, whether CAD CPI is expected if it's lower than how we'll trade CAD. And Cyrix gave you your answer there for you. But usually higher than expected print from the Canadian dollar, from the Canadian CPI, can lead to a stronger Canadian dollar. And on the flip side, a sort of weaker than expected report overall could see some weakness from the Canadian dollar. But if we get a mix of higher month-to-month data and a lower year-on-year, or either way, right, that could cause some confusion in the markets. We might see a bit of whipsawing going on, so we might not see a clear direction. We haven't seen a mix of data, from any of the past releases that we have here. It's more or less gone in one direction. But, it'll be, I think if we do get if we do see data that is mixed, then it could see more of a choppy reaction from the markets. So let me play the video from what we'd seen last time here for you for the 20th of July report. Okay. All right, so there we go. Data, if you can see there. So data was higher than, excuse me, data was lower than expected, month on month and year on year. All of the data altogether was lower. So you'd seen here, dollar CAD has seen that move towards the upside, GP CAD as well, Euro CAD too. There wasn't, so you can see that with that 0.2 deviation, that yes, the move, you did see a move towards, you did see weakening from the Canadian dollar, but it wasn't very, very strong. The only other thing I guess you also got to be aware of is the other bits of data too. So the CPI trim, which is like the core CPI month on month, not from the Bank of Canada, by the way. Bank of Canada have their slightly different way of measuring their inflation. But the Canadian CPI trim is like the core version. CPI common was the only figure in that report that was which was higher than expected, at 4.6% compared to the forecast of 4.2%. So again, I think you'd want overall all of the data, to see a stronger reaction from the markets to head all in the same direction, whether up or down, for the Canadian dollar. But if we do see more of a mixed report, then you could see more of a mixed reaction from the markets. And that's overall if everything is all choppy and a mess with CPI data. So that was the last release there. I'll kind of go forward a little bit and kind of see what else we had. So you can see even after, about a couple of minutes of trading, kind of skip forward, maybe. So you can see even after, a couple of minutes of trading that it didn't, on the dollar CAD, it didn't clear its pre-release level, okay? And it continued to eke higher, where we had seen after about 10 minutes of trading, we'd seen it was up by about 20.3 pips towards the upside from the release there. But everything else continued. You can see that the Canadian dollar continued to strengthen after the release. Go there, GP CAD. I think so yeah, excuse me, you can see the Canadian dollar, will continue to weaken. Did I say strengthened? Man, it is warm in here. Kind of the room I'm in is like it feels like a boiler room at the moment. But yeah, so you've seen that after continues, even after about 10 minutes of trading, the Canadian dollar continued to weaken. So that was a market reaction there. So we've got about a couple of minutes. Let me escape this, get that out of the way. All right, I've got there. Let me get my tick strike up and running. Okay. So yeah, key thing to remember with tick strike, all it does is it measures, what it does is it measures the momentum or the amount of buying or selling that is going on within, any currency pair, stocks, ETFs, ETNs, in internals like the VIX or the ADD, for futures as well, crypto. That's what tick strike measures. So the amount of buying or the strength of the buying or selling that is going on. Okay. So the +1 shows you if there's some buying momentum, and the minus figure shows you whether there is some selling momentum going on. We've got not too long left until the release. But as I said, we're looking for at least a 0.4 deviation on the CPI month on month and year on year. Either in either direction. Okay, so we've got about 40 seconds left. Of course, we do have the housing starts data as well from the US, but the housing starts data doesn't see too much of a reaction compared to the Canadian CPI. But yes, I think, all right, got about 20 seconds left. Okay, 10 seconds left. Okay, 0.1%, 0.1%. That is in line with the expectation of 0.1%. CPI year on year also in line with expectation at 7.6%, 7.6%, in line with the forecast of 7.6%. So, okay, so seeing some strengthening here from the Canadian dollar. I think, here we go. So we got some more, a dirty bit of data here. So a mess of a data. So 5% for CPI median year on year. CPI median higher than the forecast of 4.9%. Common CPI 5.5%, 5.5% higher than the forecast of 4.7%. Canadian core CPI is about 4%. So we're seeing a mix of data there. So the data had come in line with expectation. As said, you're looking for a blowout figure for the Canadian CPI, or much higher than expected data for the Canadian CPI if you're looking for a move towards the upside on the Canadian dollar. Data came in line with expectations, so more or less in line with expectations from economists' forecast. Excuse me. So that's some Canadian dollar strengthening. Apologies for that there. That's what we see there. So Canadian dollar strengthening, data came in line with as expected, but the other bits of data came in higher. So that could be the reason why we're seeing that Canadian dollar strength there from the markets. There we go. Okay. Okay, so that was there's a bit more of a surprise. So yeah, like I said, if you're looking for all the business data to more or less follow suit in one direction, then you would have got a nice reaction. But you've got a mix of data here. So overall, even though CPI month on month and year on year came in line with expectation, you, as said, still see that the CPI median and common were higher than expected. That would be the only reason as to why the Canadian dollar would strengthen the back of the release. It didn't last too long there. Let's have a look. What else we got? Right. Let's see how much the market's moved by. Dollar CAD, it's seen about 21.7 pips down. Okay. Oh, about 22 pips down. GP CAD, let's have a look there. Okay. GP CAD about 20 pips down on that there. Okay. CAD JPY. Okay, there's about 15 pips towards the upside. And then EuroCAD, if we have a look at that. So last time we didn't see too much reaction from the Aussie dollar and New Zealand dollar. So I'll have a check with them anyways to see how much they reacted by. But in the past, they haven't seen too much reaction recently. It's about 16.5 pips down. Okay. So if we're looking at the CPI report itself, if I just bring this over here to you guys. Okay, so what we can see, Okay, so while gasoline prices declined on a monthly basis in July, price for other non-durable goods like natural gas and groceries rose. Price increases for in-person services such as flights, restaurant meals, and hotel stays contributed to the month-over-month increase. Okay, so gasoline prices headed lower, which is nice to see. And yeah, here we go. Gasoline prices year on year rising at a slower pace year on year, at 35.6% versus 54.6% increase in June. So that would be the only reason. So more or less, economists factored it in, and you'd seen a move. But the other bits of data, the CPI common median being higher than expected, as said, would be the only releases to see cause a movement towards the upside on the or strengthening from the Canadian dollar. Let's see what else we got. What else we got here? So remember, that is so if you're looking at the report and you're looking for the year on year, if you're reading the report, it's the non-seasonally adjusted data, and it's the first headline. It's the first read there, the first line there. What else have we got? Okay, that is all from there. So, whoops, I was about to cough on the mic. Looking at the report then, just from the other bits of data. So, with the Financial Juice site is where you can get the economic release, but also other headlines too, such as, other maybe essential bankers that are speaking and saying stuff that could affect the markets. You also have other areas too. If I to make the big screen, so you also have your real-time economic releases here on the left-hand side of the figures. So you can kind of keep an eye on everything that's kind of going to affect the release or the figure or the markets from the figures. You have your live voice feed here, your news feed here with there we go, market reactions as well. And also the reports we put out for you on the site, so you don't have to go around looking for it. That's also there. All this bit of data, is in real time, and also the voice is in real time as well. Whereas the live version on the Financial Juice feed has a delay of about 10-15 seconds. So if you don't want to have a delay to your feed, remember the key thing is that with trading news or fundamental news or the macro environment, is that you need news that is going to be quick and is not going to be delayed. Okay, so Financial Juice, the website, is the key place to do that. It's what investment banks use. They use a live voice and text feed of keeping it up to date with what's going on in the markets and what's being said, or what are the economic releases that are coming out. They're also keeping a very strong eye on that. So that's a reason why what we want to do is provide you guys with a 7-day free trial of Financial Juice Pro. Now, of course, with the 7-day free, with the free trial, you get not only do you get the live voice and text service. I've pinned that up on the chat, by the way. Not only do you get live voice and text service, but you also get to access our news desk. So the news desk, basically, you can ask questions to the people on the mic or on our news desk about anything that's going on with them. Things that are going on with the markets. Why let's say the NQ or the dollar might be moving is seeing a big reaction. If there's any news correlated with it, that's what we can do here as well. And remember, the guys will always, of course, if there is a video, they'll post out a video of any live videos of people speaking, like Biden or Macklem or Fed's Powell, onto the live stream here. So not only do you get the reports, but you also, of course, take this as an example, but you can get the live videos as well of any people that are expected to speak, if we can find the video. Of course, not all the time can you find a video of somebody speaking. So that is the link for Financial Juice Pro, 7-day free trial that you can have access to. and also tick strike as well, which you've seen and you watched go off on my screen whilst we were watching the release happen. There's also a 7-day free trial of that as well. If I just bring it back up just so you guys can see it. But as said, tick strike measures the amount of buying or the strength of buying or selling momentum that's going on for any other asset. So this is what tick strike looks like. So you have forex, crypto, futures, stocks, ETFs, ETNs, and internals. That's all on there on tick strike, and you can. The key thing and the beauty of this is that you can change the level of sensitivity. So one being the most sensitive to market reactions. So if there is a little bit of buying or selling momentum that's going on, then tick strike will kind of go off with an alert for you if it matches the requirements or the basic requirements. But if you want to see like a big amount of buying or selling momentum going on, then or bigger, then you can increase that number to level 15 or that way or wherever you want to, or the higher the number you go, the least or the less sensitive tick strike will be, or that ticker will be to the market reactions. And only when there's big movements in the markets, only then will you see a reaction. Or only then will you see an alert from tick strike. So you have a visual alert and an audio alert too. I've got the audio turned off at the moment, otherwise you constantly hear it going off. But there you go. See here, there's a bit of selling going on dollar CAD, and you see tick strike kind of going off too at the same time. So if you scalp trade, or if you want to manage your risk for the day, or want to capitalize on potential trades, that's what some customers have said how they use tick strike. Of course, you use it however you want to use it. Whatever method works for you or trading strategy works for you. Then, as said, 7-day free trial is on in the chat as well. Of course, if you like the content that I put out for you, then don't forget to like and share this video, with your fellow friends and traders, and also give us a follow on Twitter as well. And then finally, so where you've seen the deviations for the economic releases or for the release, let me just close the tick strike and get that out of the way. So for the deviations for the economic release, all here showing you, how much of a deviation was there between the forecast and the actual figure, and what does that mean? How have the markets reacted to that deviation, and what does that mean? So that's also, not only for the Canadian CPI, but for the Bank of England, GDP data, retail sales, rate decision from banks, ECB rate decision. Some of these releases we used to do, but they didn't see too much reaction in the past. We kind of put them off for a little bit, but there we go. Like non-farm payrolls, a sleuth of data that you have there to look at and kind of compare with each other. But again, use it however you want to use it, and you can access that if you sign up to the mailing list on here. That's to MacRace, the mailing list. You can join up on there. And also, if there are any, what also provide is the week ahead of what to expect from the markets or news-wise or key events. Also, in that is provided a summary of the weekend news as well, and also the economic release we'll be covering for the upcoming week as well. So that's all in the MacRace mailing list. And of course, we have another little product. We have Unusual Activity, which is a relaunch of a product that we've had. But if you like trading, unusual volume activity in stocks, then you can use Unusual Activity and join our free beta test group to be able to have a little play with that too. All right, so that is Macro Ace for the week, and next week we're just going to pick up a little bit more. But that is it for the week. Enjoy the rest of your day and your week, and I will see you next time. All right, bye.